So the first session is the keynote address from Mr. Pradeep Ramakrishnan, General Manager of SEBI. I'll give a quick introduction of Mr. Pradeep Ramakrishnan. Mr. Pradeep is a graduate in commerce and a qualified company secretary. He joined SEBI in Feb 2002 at their head office in Mumbai. Initially, he worked in the primary market department, and he also worked at the Southern Regional Office of SEBI from Feb 2008 to 2015. Then he began a second stint at the head office in Mumbai. He was working in the corporate finance department at SEBI in charge of issuance, listing, compliance, and monitoring functions from 2015 to 2020. He is presently handling issuance and listing of corporate bonds at the Department of Debt and Hybrid Securities. Welcome, Mr. Pradeep Ramakrishnan. We look forward to an insightful keynote address from you. Over to you, Mr. Pradeep.
Thanks, Yogesh. Good evening, everyone, and I'm glad we have started on time. I thank Ravi and Shamik. In fact, they introduced me to this, and they have brought me in here. Thanks to the CFA Society for today evening's lecture. So I'm from SEBI, so we handle the policy for the capital market, including equity and bonds. So so it was a very interesting thing where I managed to land up here. So before I start, I should say that all these comments are all personal. They have got nothing to do with SEBI. So that is something which you have to start with. So we regularly interact Shamik and I, and at times with Ravi also, on various policy issues on corporate bonds. So because it's corporate bonds, it's it's more a lot of things are pretty abstract in the corporate bond market, unlike equities where a lot of things are in. So, and this is all, a lot of these things are very niche, and a lot of money market has a lot of bearing on the capital market, as far as corporate bonds is concerned, whereas the equity market actually stands on its own. So we need a lot of reference, and we need a lot of insight, so which we also take from a lot of people, and that's how this happened. So then one of the days we thought that, okay, why can't we also have a session? So thanks for having me here. So I'll have a very short talk today. So essentially, as to what is the regulatory perspective as far as corporate bonds is concerned, because we all know that a very well-developed bond market is essential, for economic development, and it essentially supplements the banking system. The banking system should not be burdened. Overall, always it's the banking system which anywhere in the world, including in India, the banking system has always been the biggest contributor to development of the as far as bank finance is concerned. So around the 80s, that's when the corporate bond market slowly started catching up. And we all know that there was the PSUs who started issuing bonds, and you had a lot of investors from banks and financial institutions. That's how it started. All over the world, we all know that it's still an institutionalized market, and rightly so, because of a lot of things that come along with it. Largely, most of it is private placement, and the ticket size is high. The trading, size is also, trading lots are also high. So keeping all these things in mind, it's a niche market because of the fact of the abstracts surrounding it. It's a different construct, because it's important as far as the company's longer term cash flows. Normally, that's how it is. Companies with long-term cash flows like to tap the market. Though one should say that it's actually a very stable source of finance when the equity market is volatile. We saw that during the COVID initially, when the equity markets actually tanked from, I think the Sensex went on from around 40,000 points to around 28,000 points. It was around March, April, May, when it was very volatile. So there was a time when the banking system also stepped in. There was a lot of measures from RBI, money markets, similarly the bond market also stepped in. So, and that's how it happens. So as far as SEBI is concerned, we have always been, and particularly in the recent past, we have been a lot. It's our objective, in fact, to make the bond market a very vibrant one. Which is why, as I go along, I'll talk about the recent measures also which we have tried to do. So initially, if you talk of the bond market's regulation, so we were initially issuing circulars. SEBI came in the year 1992. So we have issued circulars for equity market, and issued circulars for bond market. But the bond market circulars are not much until the year 2000. If you see, until the year 2000, when we brought in the Disclosure Investor Protection Guidelines 2000. that was when there was some some traction as far as corporate bond lawmaking was concerned. And there was one Supreme Court case, which it was Rup Kumar Sharma versus SEBI, where the Supreme Court said that guidelines have no enforcement value, which was the reason why we had to convert the guideline into regulation. And when we converted the thing into regulation, that was very we thought that okay, that was the right time for us, because the conversion work actually started in the year 2003, 2004. But then as we went along, we found that okay, the bond market also needs a separate regulation of its own. So that was how the issue of listing and debts of listing of debt securities regulations was born. That was that's how it started, and that was in the year 2008. And the traction was so much that even before the equity regulations came into being, the ICDR, that is the issue of capital and disclosure requirements for equity, the ILDS was already in place. The ICDR was 2009 only, whereas the ILDS came in the year 2008 itself. So that was how we recognized the need for a separate regulation for the bond market. And then after some 4-5 years, we brought in some regulation for the NCRPS, that is non-convertible redeemable preference shares, that also we brought in. So that's how the things started. But until the recent past, probably we had bond markets reforms, but until probably the recent past, the last 3, 4, 5 years, I should say, that there has been a lot of reforms by SEBI in that space, and rightly so, because of multiple things that have have happened, and also the fact that bond market as a source of finance has actually really grown. That was something which is something very heartening for us also. So I remember around so the last 1.5 years there have been a spate of reforms. But if you see, there was I remember when we had come to the bond market. So I've been working in the bond market for the past 1 year now. So I remember, so we started issuing circulars. Like I said, that we had one regulation and then we started issuing circulars. So a lot of circulars were issued. I think totally we had around 40 odd circulars for the bond market. So 40 odd circulars, in as much that there will be some circulars, because at one point in time, there would be some circulars some portion of some circulars which would be relevant, and there will be another portion would be relevant. So over a period of time, it became so difficult that to have one picture, for example, something like day count convention, you will find it in 3-4 circulars. So something about reporting of trades, you will find in 7 circulars. So it was finding it difficult even for us as a regulator. So we did a lot of consultation. We spoke to a lot of people, including the CFA Society. We had talks with the the stock exchanges, the depositories, market participants. We spoke to the merchant bankers also, and then we decided that okay, now it's a time for us to sort of revamp the bond market, because so there was also one particular point of concern for a lot of bond market participants. It was like, why should we not allow a bond issuer? Like the thing is, if you take the ICDR for equity, an issuer with no track record can also come and tap the equity market. Whereas the same thing was not there for the bond market. So there was a requirement of a minimum period of 3 years. So there was like suppose I'm not able to raise equity, and bank, you also want to develop the bond market on one hand, and you're sort of stopping me from tapping the bond market. Suppose I have a viable plan, if someone wants to invest, why don't you allow me? That was sort of the argument, and very rightly so. So we did consider that, and so we thought that okay, this is the time for us to sort of revamp the bond market, bring a lot of other reforms. So so first of all, what we did, like I told you, there were some 40-50 odd circulars containing numerous provisions. It was a back-breaking work for us. We sat down and we took a lot of time to go through this, and we brought in one final operational circular. So one final operational circular was released in August 2021. So it was a compendium. I wouldn't use the word compendium. It was actually an amalgam of all the circulars. So today, I think this is something which I would like to tell also through this particular seminar. People still continue to refer to certain old circulars. But if you look at the operational circular, there is annex. In the annex, we have a list of all the circulars that have been repealed. So all these old circulars are no longer in existence. They have been repealed. They have been added as chapters in the operational circular. So presently, if you want to quote, kindly quote the operational circular, the different chapters of operational circular. We have commercial paper, you have corporate bond database, and everything, UPI, application form, Abrish prospectus. A lot of these things are there. Every single thing about the bond market is actually contained in one handy book. The first part of the book is the your regulation. The second part is actually the operational circular. So so that is how we brought in that particular thing, and that has actually seen a lot of good traction in the market was very well welcomed, where we said that, okay, in case you want to go ahead and tap the bond market, you can still do it without having a track record. So though the only condition is that you have to do it through the EBP mechanism, and your shares should be offered, your bonds should be offered through QIBs. Recently, I'm very happy to tell you it's a reform which we brought in yesterday. So as far as issuers of commercial paper are concerned, we still had that 3-year requirement of 3 years. But yesterday we did that after recently there was some amendment by FIMDA for as far as issuers are concerned. So we have brought in 2 reforms yesterday, and it's a very pertinent time for me to talk because it's the first seminar immediately after the reform. The first reform is in case of an issuer of CP, and there is no track record required. So this is a big reform which we have brought in. So earlier there was a 3-year requirement for CP issuers to list their CPs. So today you can come with 0 track record also. It's just that whatever financials you have, you can disclose. Earlier you required 3 years financials. So that was a reform which we brought in yesterday. The second thing which we also brought in yesterday was that there was a requirement for a validity of your credit rating to be at least 1 month. The letter should be at least 1 month, not the validity. The letter should not be more than 1 month old. So we were also receiving a lot of queries from people saying that we are finding it difficult to comply with that particular provision because I may have a valid rating, but I may not have a letter that is 1 month old. So what is more important? Do we need a letter that is 1 month old or a valid rating? Obviously, it is the rating that is needed. So, and that is how we brought in that reform yesterday. The requirement to have a 1 month old letter has been removed yesterday. So this is very pertinent because it has just happened yesterday, and I hope this gives a good fillip as far as the commercial paper is concerned. So see one thing, like before I get into a couple of reforms which we have said, let's see what is actually concerning the debt market. So that is something which which is of very much of use to us. And which is something which we as a regulator keep on talking about, which we try to try to address. So recently, 2 consultation papers were brought by SEBI, were placed before the website on the website. The first one was capping of ISINs. So today you have 12 ISINs in case of plain vanilla bonds. You have 5 additional licenses in case of market-linked debentures. So totally you can actually issue 17. You can issue 17 licenses can mature in a year. So I mean in this formula it's 12 plus 5. So we thought that, and then we did a study, and we found that more than 90-95% of the issuers have used only less than 4 or 5 licenses, less than 3 or 4 licenses in a particular year for reissuance. So we thought that why don't we sort of try to bring it down. So because so that it actually helps in liquidity. So the idea was, why did we bring in the ISIN restriction? The idea why was just to ensure there is no further fragmentation, and that also it also sort of contributes to the liquidity. That was the idea. See, one thing which I also would like to tell you, but at this point in time, is also that the way we make rules, the way SEBI makes rules is a very consultative, participative process. We always take into account the comments of the people because we always believe the market knows what is best as far as for itself, and also it helps us in formulating a lot of rules and regulations, making us understand the market. And even suppose when we bring in something, what happens? What is the after effect? Is something which the market keeps teaching us on a regular basis. So we have put in certain, we have received a lot of comments on that particular count also. So the idea why we put in, I would like to tell you through this particular seminar, is that the idea was to reduce fragmentation and also to boost liquidity in the market. So we thought that because this was also one of the recommendations of the HR Khan committee, a few years back. So this, this one of the reforms which we thought of implementing. The second one which we have brought that is a very big reform, and of course it is still in the consultation stage. Yesterday we have extended the comments by 1 more month. So that was on market making for corporate bonds. See, market making for corporate bonds is something which is a very unique thing, which making it mandatory or even on other basis is a very unique thing, because though there has been one liquidity enhancement scheme circular of the Bombay Stock Exchange, there has been no specific market making requirements as far as bond markets are concerned. So we have one requirement as far as SME markets or SME equity is concerned. Whereas for bond markets, we have not got anything in stone. So we have tried to bring in their consulting. Again, so since the comments were received from very few quarters, and we spoke to many other people, and they were saying that they were in they were in different stages of giving their comments. They were also consulting different people. It was a new concept, how it will work, because we have brought in certain restrictions for the issuers, for the for the market, who can be a market maker, and also the different structures, structural changes also which would entail as to how much you should market make in a day, how much you should market make in a quarter, how much you should market make in a year. So, and we want to apply, so it says that it will be more than 500 crore issuers. So there are multiple things. So this is just a template which we have issued. So we have asked for comments, and we have received quite some comments, and then many others have requested that they need time because of the technicalities surrounding this. So we have extended it by a month. So we request, we have received some comments from the CFA Institute already, I should say that, and CFA Institute has been very prompt in sending comments. They sent comments on other issues also. We are very glad about that. And in case you still have any comments, and the other people who are also watching this seminar, in case you have any comments, we request you to send that also across, so that it sort of helps us. So I also will touch down upon some of the reforms which we brought in through the new NCS regulations. Like I said, the old ILDS regulations became the SEBI non-convertible securities regulations. The NCRPS regulations also were merged along with the ILDS regulations, and we brought in one regulation called the NCS regulations. Now, as far as legally is concerned, it has been highly simplified. So you have one circular and one regulation for the bond market, unlike where you had one circular, multiple one regulation, multiple amendments, and you had some 40-50 circulars earlier. So we hope that this is useful to the bond market. The first big reform was obviously, as I told you, about the fact that people with no track record can actually tap the bond market. They can come to the ABP platform, and they can use the allotted only to QIBs. And for also better price discovery and transparency, we have made it 100 crore. The ABP platform, we have made 100 crore. There is no, and this also, we always believe that these reforms will add more flexibility and also help in deepening the bond market, because liquidity in the bond market, transparency in the bond market, is something of concern, or probably of something which a lot of regulators around the world are trying to crack. Except maybe for Israel and maybe to some extent the US, the corporate bond markets are similar around the world. They are illiquid, they are highly institutionalized because of the nature of the bond itself. Because when you're, what is it that I want out of a bond if I'm holding to maturity and I'm going to get X? Unless I need something in the short term, or unless I'm going to get more in the long term, there's no need for me to dispose that particular bond. So that is from where the whole thing changes, as far as when you compare that to an equity share, for example. So we have mentioned that there is no minimum public issue size for NCDs. Earlier, in case you wanted to come with a public issue, the minimum issue size was 100 crore. So that we have removed. That regulation has been removed. The other thing is that as far as we encourage more issuances, earlier under a shelf prospectus, you could have only 4 issues in a year. So we have now said that you can have any number of issuances in one particular year, provided you make, the trans prospectus is issued. And we also have mentioned earlier, trans prospectus also used to be around, 300, 400 pages. Now we have mentioned that, we have stated that in case of a trans prospectus, only the material events and financial updates need to be given. So that also is very useful for issuers. And you can also go for, 7, 8 issuances also in a year, as opposed to only 4 earlier. So there is no limit to the number of tranches. And we have, after a lot of requests from, from issuers on risk factors, they said we need some guidance as far as risk factors are concerned, what is a risk and what is not a risk. So we have brought in certain rules and regulations on that front also. We have also taken it from the ICDR, this time tested, and where other merchant bankers also have given views upon. So we have also reduced the put and call option requirement to even 12 months from 24 months, which is also another reform. And for NCRPS, so far we have not had even one single public issue of NCRPS. In fact, even in the private space, there has been only 1 or 2, if I'm not wrong. So we have even removed the minimum rating requirement for NCRPS. So we hope, that in the days to come, we get something on that front. So that is something which is not happening. See, one other issue as far as equity is concerned is that when you want retail people to participate, you should have a proper abridged prospectus. So the abridged prospectus earlier in the debt side used to be run from 50 to 100 pages and used to be printed on such tiny fonts. So we received feedback from investors that they are finding it difficult to read. So which is why we have said that, okay, now we'll make it just 10 pages, just like equity, and you will have on size, a font size of 11, so that you are able to, read it. So we hope that this sort of encourages more investors, because They made some reforms to the UPA mechanism. Recently also there has been some amendment in the UPA mechanism also. One other, as far as the investors, this is now all these things are from the issuer perspective. Now, what do you think as far as the as the investors are concerned? Like I said, first was the separate prospectus. Then we brought in the centralized bond database. See, the centralized bond database is it's a very unique thing where you have all the information about all the bond issuers in one place, about all the issuances. Every time an issuer makes an issuance, it helps the issuer also to track its portfolio in the particular bond. What is the tenure, what is the rating, and what are the changes to the rating, and other merchant bankers and other intermediaries involved, etc. And whether it is through the stock exchange mechanism, all the information is put in that place. It is maintained by the depositories. It is open. It is free for India. If you go to the site Bonds Info, Bonds India Info, I think it's that website gives you all the information about the corporate bond market, every single issue that has been issued. So we really hope this helps in discovery and it helps in transparency, which is something which we really want retail investors to do. See, the big reforms which we have brought in, for the first time we have introduced corporate governance reforms to the debt market. Earlier it was not there. So we have issued it on a compare explain basis, and rightly so, because see, unlike equity, you have only companies which come and issue equity shares, because that is how the construct is. Very few bodies corporate, and they also are under this specific act like State Bank of India, etc. Otherwise, all of them are companies. So you will be able to state as to whether you can have an independent director, X number of independent directors, etc. Whereas issuers of bonds, even a private limited company can issue a bond and can list it under the under the provisions of the NCS, as well as under the requirements of the company. That there is no compulsion on you to come with a public issue only and then list. We can even list a private placement issue. So that is the uniqueness as far as the bond market is concerned. So we also have to be mindful about imposing it on all companies, because there are trusts which issue. Like, for example, there are authorities like the NABARD also which issue bonds. These are all big issuers of bonds. We have REC, etc. So these are all big issuers of bonds. So we need to hand them differently with kid gloves, which is why the LODR has been, we have introduced certain reforms to the LODR. Firstly, we have introduced it on a compare explain basis, because, for example, something like the related party transactions is not something which is going to be easily implementable, followed by these people, because of the uniqueness of the board structure. Like, for example, I think it is JNPT or someone, they have a board of trustees. And there was one more, I think NABARD, if I'm not wrong, they have only their board, their act itself requires them to have only non-executive directors. So you can't have impose independence. So in that case, that is why if you see the LODR says that where your statute says that you should have only non-executive directors, then in that case, they will be considered as independent. So that is again a compare explain basis. So that will take some time. We have to probably after maybe next September filing or something, we'll look at how the compliance levels are and how it is, and so that we will be able to make more further reforms as far as corporate governance is concerned. The second important big reform which we have done is disclosure of material events. See, material events are something which are very important as far as the equity market is concerned. Regulation 30 of the LODR contains a huge laundry list of events which are considered material and which also have to be considered material as per your materiality policy, and which have to be disclosed. So this is a very, as far as the debt market is concerned, was not much. So the regulation 51 has been considerably revamped, and particularly in the face of certain defaults of late, there is something which, so we have brought in certain rules, certain more disclosures, and which will also help investors. See, ultimately, for example, recently there were one or two big defaults, and some of the things which I said was that the investors did not get to know. The credit rating agency, ultimately, who are the players who are important as far as bond markets are concerned? You have rating agencies, you have debenture trustees, and then you have the bond investors. Now, the bond investors are very much dependent on the other two intermediaries. And now, for the other two intermediaries to come out with information, they come out with the recommendations. They need to have information promptly. So earlier you had the financial results once in 6 months. So we have reduced it to 3 months, just like equity. So quarterly you have results. So if you are an investor in a bond, in a bond, and if the company is listed, you will get to know on a quarterly basis as to what are the financials like. So this is a big reform. It also helps the rating agencies to revise their rating, or to take a look at the ratings also, and the debenture trustees also to see where the bonds stand and how they are. So that reform we have been doing as far as CRS and DTs are also concerned. In fact, there are a lot of reforms even in the DT space, which is also happening as we speak. a lot of circulars have been issued. So I think so. This is a very exciting period as far as the bond market is concerned. See, because if you look at bond market, what are the few things which people always ask? I mean, what are the issues around the world which is similar? First is you say that we need more players in the market. We need to have a deep market. We need to have a liquid market. We need perhaps more products in the market. And there is also one new thing which is happening around the world after the COP26 meeting at Glasgow, where they have said there is a need for a sustainable finance. Now, in case of sustainable finance, what do you need? In case of sustainable, we need sustainable products. So we have found that recently the various calls with different issuers and merchant bankers, awareness as far as sustainable finance in the bond market space is not as much. Though there have been issues of green bonds in the private space, public issues have not been much. So on that space, I think that is a very exciting space. The ESG related sustainable finance is something that is going to take off, and bond market, she's always right for it. We have already issued a chapter in operational circular exclusively on green bonds, what constitutes green bond, what constitutes green finance. So the green bonds will something which is a big trajectory which is going to happen over the next few years. See, public issues of bonds is some other issue which we would like to really have more traction in, because earlier the public issues, in fact, last year it was around 40, 38 or something. This year, and up till now, there's only 22 or 23. Compared to you look at equity, like for example, I think if I'm not wrong, around last year we had around 48,000 crore was raised, and this year already we have 58,000 crores raised. We still have 4 months to go. So which means that there is a huge, this purely in the public issue space. So in the IPO space, as far as the equity market is concerned, so we really want the bond market, public issue space also to take up. So that will take up. So over a period of time, like we have brought in these reforms, they will take some time to set in, and we hope there is a lot of traction on that space. As far as public issues are concerned. So that's it. So I've been given 30 minutes. So I've used those 30 minutes. And so thank you so much for this opportunity. And I hope this lecture was could give you some insight as to the regulator's mind, as far as the bond market is concerned. So for us, as I told you earlier, it is an avowed objective for us to deepen the bond market, to have a very vibrant bond market, as the bond market actually is a very, very good alternative, and also is a very good supplement to the banking sector as far as finance is concerned.
Thank you, Mr. Pradeep. Thank you for that wonderful discussion on Indian corporate bond markets. It was very insightful. Thank you for taking time on a Saturday to enlighten us about the Indian corporate bond market and the regulations that are in the pipeline and which will deepen the corporate bond market in India. Thank you so much.
Thank you. Thank you.